passing to the third session, which has to do with best practices for the asset management of DC plans. And the next session is going to be chaired by Mr. Chris Aesopos. So Chris is the CEO of Alpha Trust, and he's also the executive director of Alpha Trust Luxembourg. He's also the chairman of the Hellenic Fund and Asset Management Association. So Chris is a very busy man. And Chris has a rich working experience, more than 30 years experience. In the past, he was heading the asset management team at Eurobank. He's holding a first degree from LSE and master degrees from Bayes Business School and Birkbeck. So Chris, thank you very much for being with us today. And over to you.
Thank you very much, George. And it's a brilliant day. And our topic, I think, at least should not bore our audience. Best practices are something that makes the market norm. So we have three distinguished guests with us today. We'll start off with Fiona Stewart, the global lead insurance and pensions at the World Bank Group. Fiona led financial sector specialist. She joined the long-term finance team in the World Bank Finance Competitiveness and Innovation Global Practice back in 2012. She provides policy advice on pensions and insurance market reform to governments and regulators around the world. She also leads the coordination of the bank's work on sustainable finance, including representing the institution at the G20 Sustainable Finance Working Group, co-chairing the Finance Task Force under the UN Decade on Restoration. She is currently acting as secretary to the Coalition of Finance Ministers for Climate Change, and since 2004, she worked for the OECD Financial Affairs Division and led the Secretariat of the International Organization of Pension Supervisors. Prior to that, Fiona worked in pension fund industry, including as head of the American Express Asset Management in Japan. She served on the advisory board of one of the OECD pension funds and represents the World Bank staff on the organization Pension Fund Committee. She holds degrees from Oxford and Johns Hopkins Universities and a chartered financial analyst qualification. So I think it's the proper person to speak about best practices. So Fiona, your 15 minutes start now. Thank you very much.
Thank you very much, Chris. And good morning, good afternoon to everyone. Very nice to be here. As ever, let me first check with the tech is working and that you can see some slides that I have here. Does that come up okay, Chris?
Yeah, everything's perfect.
Great. Let me run through just some sort of findings that we've had around the world in pensions in the last, particularly DC in the last few years, and some of the innovations that we're sort of seeing pop up in countries you wouldn't necessarily expect, I would say. And you know, we always talk about pension pillars, but I have a proposal that maybe we should stop thinking about pillars and start talking about pensions in a different way. So if you think back to the pandemic, in some ways, I think we could almost see this as I like to call it the pension pandemic paradox. So in some ways, 2020 was almost like a stress test for pensions around the world, particularly this huge access, the massive pressure for access to funds. And this is, as many of us will know, obviously Chile was the standout for this. There was 3 different rounds of withdrawals allowed from the pension funds in Chile, 10% of funds at a time. And it ended up with almost 20% of GDP, about 50 billion being accessed from the pension funds. And now, like I think it's about 4 million people, almost half the accounts were totally emptied, because if you had a small balance, you could actually take everything out. So it really was, it was exceptional in Chile, but it really is the exemplar of the huge pressure for access to pensions that we saw in the last few years around the pandemic. But at the same time, the paradox was these long-term, these very precious sources of long-term local currency capital were shown to be even more needed than ever. And we saw some of the European pension funds purchasing COVID bonds, for example, CDPQ, one of the Canadian funds, for example, supporting its local SME businesses to keep them going through the difficult economic times. So this idea that we need the long-term currency, we need the long-term financing in the countries was even more shown during that period. So it really was a bit of a stress test and a paradox. And as well as those sort of shorter term pressures of the last few years, people on this call will know, of course, that the whole context of which, and Aaron I just saw was on the last panel has talked about this a lot, the whole context of work is changing, going from the very structured 3-stage model to this idea of a 100-year life and a multi-stage model. And do our pension systems, the way they're currently set up, really fit that longer term demographics and those longer term labor market shocks, if you like, that are coming to the system? So it's really been a real, as I say, stress test and question around the way that particularly DC systems and the way our pension systems globally have been structured. And these sort of less formal structured contexts are something that we know about and work around a lot in the emerging markets through the work that we do at the World Bank. So one thing I think we have to think about, and one thing I'd like to propose, and what we're seeing, I think, is more sort of flexibility in the way systems are being structured. Flexibility on the way in terms of contributions, and on the way out in terms of withdrawals. So in terms of more flexible sort of contributions to meet and to fit this less linear structured labor markets that we're seeing, I think there's questions being asked around, why is there one contribution rate that's kind of set for your career? Should this increase with age, with income patterns? We know the Bernardzi's Save More Tomorrow nudges that have been used in a lot of American plans, where you commit to increase as your salary increases in future. Other countries, we have subsidies for lower income workers, some sort of matching. In Korea, the government had matching for the social security contributions for farmers and the fishing industry, which really increased their contributions and increased their participation in the whole pension and longer term savings. We just heard about the robo-advisors, this idea of mass customization. Is there a way that we can fit the contributions better to what individuals are able to save at different periods? And exactly as Aaron was just talking about, this idea of communicating in units and what you get out, as well as just what you're putting in from a DC. So I think there's a lot of interesting thinking going on around the flexibility of contributions. And likewise on tax incentives, which have been a rather blunt tool. And there's a lot of evidence, my OECD colleagues, my previous colleagues have done good work on this, saying that really you're in some ways incentivizing higher income workers. Is that the best way to use your tax incentives? Can we use it in different ways, giving people incentives to make up after career breaks? Different ways of thinking. Could you even have more of a lump sum upfront for younger workers, which obviously builds a balance, which is so important for DC contributions and DC systems? Excuse me. So I think different ways of thinking around how we more flexibly put into our pensions. Likewise, again, following the sort of tech theme of the last session, interesting ways again to get to less formal workers. The idea of, we'll hear from our UK colleagues, I know, on the very successful sort of auto-enrollment for workers in the UK, different ways of thinking about using these work platforms to nudge people into longer term savings for gig workers. Bundling products has worked very well. We saw some experimentation in Kenya around a government scheme for called the Hustler scheme, which is a low cost credit scheme for informal workers, where a little bit of, when you get a loan from the government, a little bit of that could be put aside and actually used for savings or for pensions. So this really innovative ways of combining insurance and savings, credit and savings. Bundling could be a way to get to people in different fashions and different incentives. These behavioral nudges, top-ups that we're seeing, we know them through, you go to your ATM and you can top up for a charity a little bit more through a lot of breaking this link between income and pensions, thinking about consumption and pensions. Is there a way of using those sort of nudges that we've seen for different sources to go into your savings and to go into pensions? And even gamification, this idea that a lot of people using games on their phones, etc. Can you link into that and use some of these awards or points, etc.? Some very innovative in the US and being tried elsewhere around linking these sort of gamification to pensions. You could argue these payouts, again, the UK colleagues will know these idea of premium bonds, of government savings bonds that play. Some people get a payout, at certain times rather than a fixed payout from government bonds. These premium bonds in the UK, they've been used for many years, could be a cheaper way of matching contributions in some way. We can't always necessarily, it gets very expensive for countries that we work in to match all contributions. Could this be a way of having some sort of incentive-based match from a government? So again, I think innovative ways are coming up around incentivizing and flexible how we get contributions into our longer term savings. Just a bit of a reality check that we did, that a lot of these top-ups have been used for shorter term and other type of consumption. The issue with pensions, as we know, you need a lot to go in to get the significant pension out, as Aaron's calculations show. So just on a sort of flippant note, but you need to have an awful lot of Starbucks a day to really top up to get to a proper replacement rate for your pension. But it's one mechanism that we can think of as adding into the mix. And then the question of, do we actually need flexibility on the way out as well, and how we withdraw? And there are, compared to Chile, for example, we saw in Mexico around the COVID period, actually Mexico's always had some access, controlled access for sort of emergency and needed reasons. And that actually worked pretty well during COVID. And we didn't see the huge outflows that we saw in countries like Chile or Peru, where there's been more controlled or less access in the past. So maybe having these defined ways of accessing takes the pressure off a little bit, and actually gives people more confidence that they can access some of their funds if they need to, and actually encourages people to keep money in and to actually contribute more. Purposes, many countries around the world allow some, again, controlled access for education or home purchase. And sometimes even having a little bit allowed at certain points through your working life, we did some modeling of that, could be relatively less impact on your ultimate DC pension, but again, gives people a little bit of confidence that they can access if and when they need to. There's thought about how you could standardize sort of loans from your pension funds. And then I'm sure our UK colleagues will talk about this idea of having a long-term savings and a short-term savings pot together, which they've been doing some very good pilots on through the Nest system. And South African colleagues are looking at this idea of these two pots together. So you build a long-term and a short-term savings, so you're not always looking to dip into the long-term. And I think it's something like $4 in every 10 that go into a 401k here in the US get taken out. Well, can you have a short-term savings that allows you some of that access, but doesn't mean you're always dipping into the longer term savings, which we know is so important for building up DC accounts. So if you put all this together, so my theory is that we need to think about not pension pillars, which maybe have been too rigid in some ways and have crumbled around the real stress tests we had over DC pensions. Maybe we need to think about a pagoda, which has more of this flexibility built in. And what we always say around the World Bank advice is always you need a very solid, strong central pillar of social protection for the groups of the population that won't be able to save. They will always need support from a government. That solid central pillar needs to be there of social protection so that we know that the basis will be covered. And then how do we build layers of more flexible contributions and more flexible benefit payments out around that? So I think thinking about this new ways of designing our pensions, and a lot of the fintech accessing through mobile phones, easier to contribute, getting more advice that's tailored towards us, is starting to open up access to less traditional workers who don't necessarily have a payroll and employer, and being able to tailor and to get that flexibility into our system. So that's some of the thinking, I think, around the world, and happy to hear from Timo and colleagues about what's happening in Europe and elsewhere. Thank you.
Thank you very much, Fiona. We'll have a Q&A session at the end. So we can now have Louise Davey. She's the Director of Regulatory Policy, Analysis and Advice at the Pensions Regulator. Louise has been with TPR for the last 15 years, primarily leading the development of regulatory policy across DB and DC, and also public service schemes. Before joining the regulator, Louise held technical roles in the pensions industry, ranging across personal and occupational pensions, third-party pension administration, and TPAs, the Pension Funds Advisory Service. So, Louise, the floor is yours.
Thank you very much, and good morning, good afternoon, everyone. I am similarly just going to attempt to make the technology work now. So hopefully you will be able to see some slides appear. Okay, are you able to see those slides?
Yes, but they're small in size.
They're small in size, okay. Let me, is that better?
No, because there's a click to add text, big box under the slide.
Okay, right, let me try it again. Okay, they should. Is that better?
No, we've got a black screen.
Oh, okay, I don't understand why this isn't sharing, because I've got them on all of my screens at this end. So, okay, let me try again. Okay. Anything so far? Oh no. Okay. I don't know. I know Maria has my slides. I wonder if the backup we might be able to share from your end instead.
No,
it's good.
Okay, it's good. Excellent. Okay, right. So we'll try that again. So yes, good afternoon, everyone. So yes, I thought I'd give an update on some of the kind of latest experiences and developments in terms of our experience of supervising DC pensions in the UK and how that has evolved over the last decade or so in particular. So so this slide kind of shows a fairly good illustration of how the shape of the DC market has changed in the UK since the introduction of automatic enrolment in 2012, whereby employers have a duty to enrol workers into a pension scheme by default under arrangements where the worker is not required to make any choices at all at the point of enrolment. And this has proved to be a very successful policy. The middle chart on this slide shows that memberships of pension saving have grown by over 1,000% during that period, and that more than 26.4 million people have been automatically enrolled over that time. So it has been a very successful policy in terms of getting people into pension saving. And the shape of the market has changed as well, in that although we've seen a huge increase in membership, we've actually seen a 67% reduction in the number of DC schemes that are in existence in the UK in terms of trust-based pension schemes. So in 2012, there were just over 3,500 DC schemes, and that has now reduced to just over 1,000. And this is as a result of the introduction of master trusts into the market, which really came about because of automatic enrolment. So these are very large multi-employer schemes that have taken on the vast majority of new DC pension savers, and who are actually also taking in the members of existing DC pension schemes as well, who are choosing to move their members into a master trust or different larger arrangements and wind up their smaller arrangements. So we can see that the number of members has hugely increased, the number of schemes themselves has hugely decreased. And we're starting to see that the average assets per member are now starting to rise. Obviously, when we saw a large number of people moving into pension saving that had not saved before, we saw the average pot size plummet, as you would expect. But we are now starting to see that increase again. And in terms of total assets, the scheme assets have increased by 550% near enough. So I think we can say that automatic enrolment has been hugely successful in that regard. And as I said, 90% or more than 90% of DC savers are saving into a master trust. And these arrangements are authorised and supervised by the pensions regulator. This is in contrast to non-master trust DC schemes, which aren't authorised. We do regulate them and they are overseen by the pensions regulator, but there isn't a sort of formal systematic authorisation and supervision regime in place like there is for master trusts. And it's important to point out that in addition to trust-based occupational pension schemes, which the pensions regulator overseas, there are also contract-based pension schemes which are overseen by the Financial Conduct Authority. So these can be used as work-based pensions. An employer can choose to take out a group contract for their employees, but they don't fall under TPR's remit, but they do still form a fairly significant proportion of provision for DC saving. So that's kind of how the market has evolved in terms of DC over the years. And one important development is that historically we have seen in DC that when employers are selecting a pension scheme to put their savers into, the key focus has been on cost. And there was, in fact, a charging cap that was introduced back in 2015 to ensure that pension scheme providers could not charge more than 75 basis points for the default arrangement within their master trusts. And that has very much been the focus for a large number of years. But in actual fact, most pension providers are now operating at a much, much lower cost than the charge cap. So there is now a much greater focus on making sure that trustees of pension schemes and our employers, when they are making a choice about which pension scheme to choose for their employees, to focus on the overall value that is being provided and not just which one provides the lowest cost. Now, at the moment, there's a big barrier to doing that because there currently isn't a consistent and effective way for trustees or employers to assess their value against other schemes in the market. So this runs the risk of people being in very poorly performing schemes because the data is not disclosed and shared to enable those comparisons to be made. So we are proposing and this is a joint piece of work with the Financial Conduct Authority because, as I said, there's two forms of pension scheme. There's the trust-based pension schemes and the contract-based pension schemes. But from a saver's point of view, they really don't know which kind of one they're in, and they don't know, who the regulator of that scheme scheme is. So, and it shouldn't really be important for them to know that. The important thing is that they should know that they're getting value from their pension scheme. So both we and the FCA are jointly working on introducing and delivering a disclosure framework, which will force pension schemes and the broader industry to collect and disclose specific data points and compare performance. And we believe that this will drive improvements in the market, and it will ultimately lead to better saver outcomes. So the graphic that's on the screen here sort of outlines the sort of logic for introducing this and the outcomes that we expect to see. Importantly, the data that will be disclosed, it will be consistent. So every scheme will have to disclose the same data over the same time periods. And though that data will cut across 3 key elements that we believe form the basis for a value for money assessment, and that is investment performance, costs and charges, and quality of service. And the idea is that schemes will collect and they will report on a set of data metrics that go across those 3 elements, and then they will undertake a comparison against benchmarks or against other schemes, and that is still a piece that's in development around whether there will be benchmarking or whether it will be relative assessment. And they will have to then undertake an assessment of the value for money that they are delivering against the rest of the market and make a declaration on that basis. For schemes that do not demonstrate value for money or are not able to pass that value for money test, will be expected to put in place either a very robust plan to improve and demonstrate how they will reach a point where they are providing relative value, or they will need to transfer their savers into a scheme that is providing better value and leave the market. So we expect this initiative to continue to drive further consolidation within the DC market. It has been our experience that, and this has been shown consistently through surveys that we have carried out, as well as kind of just anecdotal evidence, but certainly there is a very strong trend that says the larger a scheme is, the larger the budget they have, the better the resources they have, the better the standards of governance and the better outcomes that they deliver. So we strongly expect that the value for money framework will show this, and that we will see the number of schemes reducing further over a period of time. So that's the value for money framework, which is a key piece for us in terms of making sure that savers do now get very good value from the schemes that they are saving into, and that focus does move away from just on the cost alone. There are some other challenges that we're facing in the DC space since the introduction of automatic enrolment, and one of those is that because people move employment very often, we don't at the moment have a system where someone stays with the same pension provider through all of their employment. Every time they change to a new employer, they will generally be going into a different pension scheme. So this means that there's been a real proliferation of small pension pots. So individuals might have, 5, 6, 7 different pension pots scattered around, which could be providing them with a suboptimal outcome because of the multiple charges that they will be incurring on those pots, and also there's an administrative burden for pension providers to be administering lots of small pots. So there's some solutions that are being explored here. One key one which the government is looking to take forward is around multiple default consolidators. So this, the model for this is that where an individual leaves a small pot in a pension scheme, if it is under a certain amount, and currently the thinking is that will be around about £1,000, then after a period of time, if the saver has chosen not to do anything with that pot, it will be automatically transferred into one of a small number of consolidators who will have been authorised as a consolidator. So that is intended to kind of deal with the existing stock of small pots that we have, and to stop further small pots arising in the future. There's also solutions being looked at which will be undertaken more likely on a voluntary basis, primarily by some of the larger master trusts. So, for example, there's a high chance that because there's a small number of master trusts which are used by a very large number of employers, that individuals could have multiple pots within the same provider. So we would be looking to those providers to actually consolidate those pots within their scheme, just as a matter of course. And also there is exploration of a solution which is looking at member exchange. So where, again, particularly large master trusts, where they have members whose pots and investment profiles look very similar, instead of actually moving the money around, there could be a member exchange that happens, so that there isn't actually any transfer of assets, but the position would be that a member would end up with their pots being consolidated. So those are some of the solutions that are being explored there. And there is, at the very early stages now, government interest, and we're expecting there to be government consultation on a lifetime provider model, or a pot for life, as it's been named. So this is where this would be very sort of similar to the Australian model, where an employee chooses one provider when they first start work, and that provider stays with them across multiple employments instead of them changing each time. And that again will stop the creation of multiple pots, but also there's a belief that it will likely increase saver engagement, because they will see a pot of money that builds much more over time, instead of having lots of smaller pots that don't seem so significant. And finally, the challenge that we are increasingly facing is how best to decumulate, or how best to access DC savings. So the whole system of automatic enrolment is based on inertia. It's based on individuals making no decisions. They get put into a pension, and that happens unless they say they don't want it to. But in 2015, we had pension freedoms which were introduced, which means that there is no longer a default option at the point a person comes to access their savings. The individual is required to make a decision about what they want to do and how they want to draw that pension. So this means that savers who have potentially been quite unengaged with their pension saving throughout their life are then faced with quite a complex decision. And coupled with that, the cost of financial advice is often prohibitive. And in any case, in the UK, we have a bit of a shortage of advisors at the moment who are able to advise in this way. So there is a review going on at the moment, which is looking at actually what's the boundary between regulated advice and guidance. And this goes to the previous presentation, talking about actually how can options be presented to savers, and how can they best be supported to make good decisions with their retirement savings, and how far can trustees and pension providers go with that without crossing the boundary into regulated advice, which would mean that a sort of whole different set of processes. And coupled with that, it's likely that we will be moving to a place where pension schemes will be required to offer decumulation options directly from the scheme, or partner with the provider. So whilst it wouldn't be a default option, there would be a kind of easy pathway to a good retirement solution for individuals. I don't think at the moment we will go as far as having a default option being introduced, but that is something that may be considered further down the line. But the key point is that because retirement now looks so different to how it used to, in terms of the shape, people want to take their income in different ways at different times. There's a real push for products to be developed to meet those different needs during that decumulation phase. And that's one of the key challenges that we're just quite kind of starting on at the moment in the UK, as we see more people reaching retirement where actually the bulk of their saving has come from DC rather than DB. So that was a bit of a whistle-stop tour of some of the challenges and opportunities and trends that we're seeing in the UK. Yeah, I'll be very happy to obviously take questions later on in the session. Thank you.
Thank you, Louise. And we can move on now to Timo. Timo Löyttyniemi, the CEO of State Pension Fund in Finland, also called VER. It is a government buffer fund which manages pension assets related to government pension liabilities of state employees. VER has over 20 billion euros under management, and during the years from 2015 to 2019, he was the vice chair of the Single Resolution Board in Brussels. The board has currently over 70 billion euros under management in its resolution fund. Before joining SRB, he was the CEO of State Pension Fund between 2003 and 2015 and returned back in March 2020. Earlier, he had worked in various roles in banks and investment banking. He has served in a number of boards in companies and foundations, and also in a number of investment committees. He holds a PhD in economics. So, Timo, it's been a pleasure. The floor is yours.
So, thank you, Chris. And first, checking that you can see my slides.
Yes.
Yeah, great. So, in these 15 minutes, I will go through the best practices in public pension investment management and some of the observation also regarding the last few years where we have been facing some crises in the market. So I will start my talk in terms of briefing, just in terms of what we do. Hello?
Yeah, you can put them on full screen mode if you can.
It's not yet. Or sorry. I tried to do it. Is it now in full?
We're not seeing anything yet.
Can you see now?
I'm afraid not, Timo.
Sorry.
Louise, would you like to answer a question that we have from the audience until Timo's slides are on?
Yes, I'm happy to do that. Yes.
Okay, the question is, how are pensions from DC plans taxed in the UK? What is the taxation policy? In your view, should pensions be taxed given that they will be used in retirement when people have no labor income?
Well, I mean, the way the second part of the question, the way pensions are taxed, I mean, obviously that's, you know, a kind of a government policy question. The system is that contributions and investment performance are tax-free, and that income is deducted at the point where someone takes their pension. It's taxed as income. According to someone's income rate. I think that has proved to be a fairly successful tax policy. There is often discussion within government around whether there should be changes to that policy, but there hasn't been appetite to change it so far. It does seem to be a fairly successful, and it is one of the kind of key pieces of automatic enrolment in terms of explaining to people what the benefits of saving into a pension are. So I think for the time being, I don't anticipate there being any changes to that policy.
Thank you.
Let's try this PDF site. Can you see me? Can you see it now?
It's a black screen saying that you have started.
Do you see the screen now, or? So I've now sent it to Maria if she can share it from your angle, but I don't know why it doesn't show up here. Let's try. Can you see now?
No.
Sorry.
Maybe in the interest of time, Timo, sorry for intervening, and Chris, sorry for intervening. Maybe in the interest of time, Timo, you may wish to start without your presentation. As soon as Maria receives it, then she can display it.
Yeah. Yeah. All right. So it's coming. It's in Maria's email. So anyway, in terms of the starting point in the state pension fund, we are managing 22 billion euros, and we have been very cash flow positive through some years back, and now we are very much going to be cash flow negative. So this cash flow negative certainly will have a life cycle element into the future, but so far we have been managing the monies and the pension fund as we have been purely assets only type of investor. So not LDI and not either a life cycle type of model. But in the coming future, we have to tackle that question in the meanwhile. So in terms of best practices, I've planned to look at the topic of public pension investment management from these four words. So first, my comments will be on the public side. What does the public element of the public pension investment management look like? And the first fundamental question is the fundamental integrity of the pension fund, because if it's a public entity, then there are certain public elements and public administration elements which certainly play a role in terms of what one can do and what one cannot do. As an example, the changes will not be quick in terms of at least if the owner's decisions are needed or the law changes are needed. But in terms of organizational development, I think everything is exactly the same as in the private world. Then the second item is the managing transparency. There will be certainly transparency issues. How to manage that will be dependent on any pension fund. And then the next one is the good governance and also the implementation of that good governance. So certainly all pension funds has the owner, and then the owner decides on the board members, etc. So that needs to be taken care of. Then the risk appetite is an element which is always a tricky question, because there's no one willing to say what the risk appetite is. And therefore, we as a pension fund, as an example, we have to figure out it ourselves. and then we have to put pieces in together in order to determine what is our interpretation of the risk appetite. And then related to it is the limit setting, if the limits are used or not. And then always public pension fund needs to look at the clever use of resources overall. Then the second element will be this pension. So pension element, and the first element there is what is the length of the horizon. Typically we say that the pension funds are long term, but I would say rather that it's a medium term. It, of course, the one calculates the liabilities and discounts those into present value from long term. But in terms of management of the organization, management of the investments, I would still say that the medium term is the right one. And how long is medium term? Possibly 5 to 10 years. There are some jurisdictions where legal changes are taking place. And typically, whenever legal changes are taking place, I think those are the turning point of the key points of decision making. And therefore, those points will be determining the length of the horizon. Then pension administration may be needed to be in-house or external. And we as a pension fund, for example, if you go to page, a few more slides, please. Yeah, that one, thanks. So, and there on the right-hand side, the previous one, please. So in the previous slide, there was also a picture of a mapping of the horizon, and then also the alternative investments. And I would say that whether there are public pension funds which could be very liquidity driven, there could be LDI driven, normal DB, normal DC, and then buffer funds or sovereign wealth funds. So all these elements could be there in terms of various pension funds, and therefore one has to determine where in this map one lies. Then the next slide, please. Then, of course, I would just say here that all pension funds are unique in character, so there's no one pension fund which is similar to another one. Then a few words about the investment side. One needs to decide whether it's assets only or LDI type, whether the liabilities, of course, always have a meaning, but how tight is the connection between the liabilities and investments, that shall be determined. Then investment beliefs, and I'm soon coming back to that. Investment management, in-house, outsourced, index, active management, liquid, non-liquid. And then there are fee negotiations, which we heard in the previous talk, some angles to that. And then, of course, one needs to look at net return, not only the cross and the cross fees or net fees, but the net return, of course, is the determining factor. Then I have an example of investment beliefs in the next slide. We have determined our investment beliefs many years back, and if I put that in the 5 building blocks, it will be the strategic asset allocation, which certainly determines the expected return and risk level, diversification of both asset classes and factors. Efficiency of the market is certainly determined in terms of how much of active management we shall have. Typically, I would say that in our category, it will be in the public domain. Half of the funds are managed at least passively, and half of the funds actively, depending on the area. And then ESG certainly reduces risks, but creates opportunities at the same time. And then personal resources and skills are essential for successful investment management. Then next slide, please. And then the last element is this investment management picture and organization and organizing the organization. Certainly the leadership and motivation of personnel has a meaning. Key partnerships, if one sources some of the functions, then of course those are long-term partnerships which one needs to establish. And then clever investing, and certainly I would say that for all of us in pension industry, and especially the public one, strategic asset allocation plays the key role. And I would say that it's at least 95% of the success. Crisis management, rebalancing are keys when from time to time crises we are facing those. And decision layers, one needs to have a delegation hierarchy, which is functional. And at least in my case, I've been trying to use this delegation authority as much as possible and not to decide too much, meaning that if one is too active in terms of asset management, then academic literature quite nicely is backing that those kind of too many decisions is possibly not the wise way to go forward. And then for organization, learning and developing is the constant matter, which we are all working constantly. Then next slide, please. The next slide shows evolution of one pension fund in terms of how the asset allocation has been developing the last 20 years. These colors are showing various asset classes, how they have been, weights have been changing. And on the right-hand side, I have just highlighted that strategic asset allocation changes are dependent on market capitalization changes, new asset classes emerging like private credit, interest rate level changes that we have been seeing recently, and new products and opportunities arising, and then also organizational development. So it's not only strategic asset allocation which fits for all, but it's all of these combined. And then next slide, or actually the final slide, and to conclude, I will just say a few observations in the next slide, some observations of the last few years when there have been crises in the market. So has anything changed for pension fund? And I would say that the following list, which is a list of 10 points. The first one is that we are at the mercy of the markets. Risk and management is typically misunderstood, especially by laymen. One cannot reduce the risks if the expected returns are good. Timing is always difficult, as we saw March 2020. Risk reduction may even increase the risks if one misses the best days in the equity market, at least. And the worst for public pension funds is a recession lasting several years. And we always need to be humble before the market. And then it's hard to predict the timing of countermeasures and public backstops by the governments and central banks in the crisis. And then time frame for liabilities is absolutely one of the key elements. And combination of strategies, meaning the strategic allocation and rebalancing, are key elements, especially in crises. And then pension fund needs to do the continual improvement. So these are my thoughts in terms of the best practices for public pension investment management. And sorry for the hassle in the beginning of my speech. Thank you.
No problem at all. Thank you very much, Timo. So we've got two questions, three questions from the audience, and probably one from me. We've got another almost 5 minutes. So starting off with Louise, is the UK likely to introduce an income covenant for trust and group schemes?
It'd be helpful if the person that asked that question could explain exactly what they mean by income covenant, because I think it might be interpreted in different ways. So
I have no idea. It's written on the screen. So income covenant for trust and group schemes.
So in the DC context, I mean, I think there will be likely requirements, as I said, for schemes to, and I'm interpreting this as what that means, for schemes to offer directly income options for people when they access their pension. I don't know whether the interpretation of that question is actually related to as a person's income increases that their pension contributions increase. I don't think that is something that is being actively considered at the moment. So hopefully that answers the question. A couple of different interpretations of it there.
Thank you very much. Moving to Fiona now. From your experience, do DC plans take ESG into account when forming their portfolios? However, if they do, they may forego profits. Is this good for the pensioners?
That's a very large question to answer in a minute. But so yes, it's not, the plans around the world are increasingly looking at ESG issues. For example, there's regulation coming in the DC systems in Latin America, which are largely DC, and they still have increasingly sustainability reporting, etc. Requirements. So it's not a DB or a DC phenomenon. It's certainly a phenomenon around the world that this regulation and practice is coming to incorporate ESG for pension funds. The whole does it have an impact on performance is again a very large question. I think funds are increasingly under fiduciary duty being required to look at these issues for financial material issues, and funds in addition are increasingly looking to have performance and outcome measures in addition to their financial ones. So lots of trends, but it's not just DB, it's for DC funds as well.
Okay, thank you. I think this covers the next question, which is also on performances on ESG placement. So I would ask one question to Timo this time. You said we're in the mercy of the markets, and you're very right. Looking back from the Lehman crisis to today, we had two blips. The one was the first COVID era, and the market shoot up right afterwards. And then we had the nasty 2022, and the markets are up today more than that. So as we're in the mercy of the markets, and we are always looking forward with the historical data that we have, we're all pretty certain that DCs will continue to thrive and provide what they're promising to the pensioners. My question is DC the proper and the only solution going forward, or do you think there will be a new transformation as we went from DB to DC, and now we will start moving from DC to something else?
I think it seems that the movement from DB to DC is a constant one. Different jurisdictions are implementing that change gradually. And it seems that the Dutch model also shows that it takes many years before the decisions are executed. So that's, and I would say that, of course, it's also the design of the DCs, especially at the later stage after one has retired, that one doesn't invest the monies or the responsibility is not fully transferred to individuals. So I think there must be some collective elements. But you are exactly right that these crises are certainly elements which needs to be handled and looked upon, that those doesn't generate some low pension challenges for the future.
Thank you very much. And George, back to you.
Thank you, Chris. Thank you very much for chairing the session, and may I also thank our three distinguished speakers for providing their valuable views. So once again, thank you very much.